January 2, 2002. The Real Estate Capital Scoreboard. January 2002. Last year proved to be one of the most tumultuous years in recent history, both politically and economically. Ironically, despite significant fluctuations throughout the year, long-term interest rates are nearly identical to a year ago. However, lenders are more cautious of providing proceeds and spreads are slightly wider. The real winners in the mortgage markets are borrowers using floating rate debt indexed to prime, LIBOR, etc. These rates are as much as 500 basis points lower than a year ago. In mid-December, the Fed cut short-term interest rates by 0.25%, the 11th and final cut. The rates reflect the lowest levels in 40 years. The combined cuts translate to a 4.75% decrease in short-term rates during 2001. The weekend economy still concerned policymakers and another cut is expected this quarter. February 1, 2002. The Real Estate Capital Scoreboard. February 2002. Tighter mortgage spreads combined with lower interest rates translate to an overall drop in fixed-rate debt of approximately 0.25%. Spreads dropped by about 10 basis points as lenders are awash with cash for 2002 production. Floating rates remain at historical lows. However, fixed-to-float and vice versa programs are very popular funding options for borrowers seeking the best of both worlds. One-time conversions offered during the first half of the loan term are common. Lenders are also extending credit underwriting in an effort to expand loan production volume. For instance, non-investment grade, single-tenant financing offered based on real estate underwriting versus low debt service coverage. Intense focus on reviewing and dating insurance policies by mortgagees in light of September 11.
March 1, 2002. The Real Estate Capital Scoreboard. March 2002. Treasuries are approximately 0.25% lower than a month ago. In contrast to last year, rates are slightly lower by about 25 basis points. Permanent fixed-rate mortgage pricing tightened by 10 to 15 basis points for full leverage loans, 75 to 80% loan-to-value. Most loans for conventional properties are priced within the 210 to 230 basis point range, translating to rates of 7% to 7.25%. As continues to be the case for the past few months, short-term floating rates remain at historical lows as overall pricing is frequently below 5%. Refinancing demand remains healthy as borrowers opt to recapitalize properties instead of outright sales. Many believe that 2002 will be a slower period of recovery, expecting more equity market liquidity in the latter part of the year. April 1, 2002. The Real Estate Capital Scoreboard. April 2002. Overall fixed rate, permanent mortgage pricing increased by 50 basis points over the past 30 days. Yet the higher end of the rate curve tightened as lenders attempt to maintain market share. The rate increases are in direct correlation with Treasury bumps, even after absorbing narrower mortgage spreads. Mortgage spreads continued declining throughout the month, dropping another 10 to 15 basis points, over 0.25% drop since the beginning of the year. The Fed's decision to keep rates steady signals that the bottoms of the rate curve may have already been reached. May 1, 2002 The Real Estate Capital Scoreboard-May, 2002. As is commonly known, the real estate capital markets are flushed with cash. Lenders and equity investors alike are starting to move from the sidelines as economic recovery progresses. As has been the case for much of the first quarter, mortgage spreads are compressing, as much as 5 to 10 basis points throughout the past month. Strongest demand still remains for apartments and credit deals. However, more lenders are expanding into different property categories including medical office, self-storage, manufactured housing, etc. Overall rates remain close to historical lows that span the past 40 years. Taking into account the spread drops and Treasury rate increases, rates are about the same as February levels.
June 1, 2002 The Real Estate Capital Scoreboard-June, 2002. Despite various property market issues, lenders are willing to explore a wide variety of funding options and underwriting platforms. In other words, it is clearly borrowers' market for good quality properties over all types including hotels and office buildings. Since spreads between fixed and variable rates are narrowing, more borrowers are exploring fixed-rate options, fearing that the economic recovery will translate to higher interest rates. Overall rates remain close to the lowest levels in modern history. Current Treasury rates are nearly identical to the beginning of the year. Longer-term Treasuries fell by about 10 basis points this past month while short-term rates remained unchanged. But after adjusting for lower spreads, rates are about 50 basis points lower on an absolute basis.
July 1, 2002 The Real Estate Capital Scoreboard-July, 2002. Long-term rates dipped even lower this month, dropping nearly 40 basis points for 5-year Treasuries and more than 25 basis points for 10-year term. Combined with universal drops in mortgage spreads, rates are lower by as much as 50 basis points. Treasury rates and mortgage rates approximate levels available the fourth quarter of last year. In other words, pricing equates to just over 5.5% for short-term loans and about 6.5% for longer-term loans. Once again, short-term rates remained virtually unchanged throughout this year as the Fed's monthly meeting yielded no change in rate policies. The same applies to real estate equity markets. August 1, 2002 The Real Estate Capital Scoreboard-August, 2002. July closed as one of the most volatile months in market history. Inversely mirroring the stock market, Treasuries reached record low levels, as a 10-year bond fluctuated by 50 basis points, settling about 25 basis points lower. Mortgage rates hit 40-year record low levels. Most fixed-rate loans are available below 7%. However, lenders continue enforcing loan floors ranging from 6.25% to 7.25%, depending upon the loan size and property type. Capital flow into mortgage markets remains unabated. As a competitive edge, more lenders are packaging first and second mortgages together, providing construction with permanent debt programs, as an example. Commercial property values hold steady, as strong demand exists for high-quality assets across all property categories. Capitalization rates slightly drop in response to favorable interest rates and buyers enjoy some yield spread advantages. September 1, 2002 The Real Estate Capital Scoreboard September, 2002. In August, rates dropped more than 0.25%, once again closing at record low levels in response to weakening equity markets. Rates were less volatile than in previous months, fluctuating within a narrow range of about 15 basis points. Mortgage spreads are on a steady course. And has been the case for most of this year. Lenders are imposing floors ranging from 5% or more. Of course, should rates continue trending downward, the floors will drop again. High-quality, conservative loans attract outstanding pricing. For example, rates as low as 5.125% for 10-year terms are available for lower leveraged, for example less than 50%, larger loans in excess of $10 million. October 1, 2002 The Real Estate Capital Scoreboard October, 2002. Treasuries continue sliding downward, even after reaching record low levels. In fact, during the past 2 months, the 10-year Treasury dropped by more than 50 basis points. The Fed kept rates unchanged in September, helping to push rates to a 41-year low for the third time during the past quarter. Refinancing is picking up momentum for fixed-rate debt as the gap narrows versus floating-rate debt. The sweet spot in the debt marketplace appears to be for 5- and 7-year maturities. For lower leverage loans below 65%, spreads over treasuries are as low as 130 basis points.
November 1, 2002 The Real Estate Capital Scoreboard November, 2002. October was a roller coaster ride as rates bounced by as much as 70 basis points. All in all, treasuries are about 40 basis points higher than the previous month. And for the first time in several months, LIBOR is moving downward, settling about 10 points lower. Continued pressure on capitalization rates to drop as property sales are few and far between. Many buyers are now more comfortable with more aggressive pricing as lower rates appear to be a long-term trend. Borrowers eye fixed rate versus floating rate debt, as rates seem to have hit bottom. December 1, 2002 The Real Estate Capital Scoreboard December, 2002. During the past 6 weeks, rates have moved up right nearly 0.25%. Mortgage spreads are relatively unchanged, however. Much of the financing volume earlier in the year focused on refinancing, while the final quarter points to more acquisition activity. Sellers and buyers are adjusting expectations for sustained lower interest rate conditions. The Fed leaves rates unchanged, maintaining the lowest figure since July, 1961. Most analysts believe another rate cut is unlikely in the near future as policymakers assume that inflation risk is in balance with slower economic growth.